Apple recently announced earnings for their third quarter of fiscal year 2023. Their earnings results were actually pretty optimistic, so we're going to get into it. We can see that over the last year, they're up 8%, while the rest of the market is also up 8%, so they're basically on par with the rest of the market's return over the last 12 months. I'm going to look into some of the recent news that came out. I'm going to look into their financial statements and then use a discounted cash flow model to figure out the intrinsic value per share for Apple. So right here, this article is titled One Top Tech Stock to Buy During a Recession. We can see that they point out that Apple has a strong balance sheet and free cash flow generation, which could help it weather whatever storm comes its way. And Apple's customers have a heightened interest in their new products and services. Right now, to curb soaring inflation, the Federal Reserve has continued to raise interest rates very aggressively all the way from the start of early 2022. And the rate hikes have been the fastest in history, and a lot of market participants are still worried that a recession could be on the horizon despite the resilient U.S. economy. Unemployment is low, inflation is cooling down, and the labor market is strong. And investors basically think that during a recession, the top priority should be financial strength when looking to try to invest in a company, and that makes Apple a no-brainer portfolio addition during economic downturns. So they touch on right here the fact that Apple is arguably in the best position of any corporation in the world in terms of financial position. They have a net cash position of $57 billion. They have ridiculous amounts of free cash flow, which is essentially the amount of cash profits a company has after they reinvest for growth. And in fiscal 2022, which ended September 24th, 2022, Apple generated $111 billion of free cash flow, with $90 billion of that coming from the first 3 quarters of the fiscal year. So that's a lot of free cash flow, obviously, and that puts them in a very powerful financing and pricing position. Right here, they touch on the fact, or they ask the question, why does favorable financial position matter so much? And they touch on the fact that in a recession, capital markets typically tighten as lenders and investors operate with more rigid standards. And this makes it a lot more difficult for companies to raise capital at attractive debt terms in order to continue their operations and to grow their company. But Apple doesn't have to worry about borrowing money or issuing new shares to raise capital because they already have a lot of capital, more capital than they know what to do with. And that's very beneficial to shareholders because they'll have zero problems weathering any prolonged economic downturn that could be on the short-term horizon. They also touch on the fact that the iPhone maker has the financial resources not only to survive but thrive. They're able to play offense and invest in new initiatives while their competitors are playing defense because they aren't as fortunate. They touch on how one of the main skepticisms surrounding Apple's position in the market is that their products, the iPhone 14 Pro, MacBook Pro, for example, are very expensive and that customers won't buy them during recessions. And they say that's a fair assessment, but it's important to note that during the great financial crisis more than a decade ago in 2007, 2008, Apple posted double-digit revenue growth. And so that, coupled with the fact that the average Apple customer is a little wealthier than your average consumer, it means that Apple could be better equipped from a financial perspective to continue spending on tech products. So those are a couple of reasons why this article touches on Apple might be a really good investment at the moment because of the shaky economic times we're in. And if there is a recession, Apple's strong cash flows and strong financial position could position them to grow during a time period where their competitors are shrinking. So right here, this is their income statement. We can see net sales declined by about 1% from 83 billion to about 82 billion year over year. And net income increased from 19.4 billion to 19.8 billion, up around 2.3% year over year for their net income. Balance sheet, they have total assets of $335 billion, and then they have mostly liabilities compared to equity. They have $270 billion of liabilities, $60 billion of equity, and they also have retained earnings of $1.4 billion. Lastly, for their cash flow statement for the first 9 months of their fiscal year, They've had operating cash flow of 88.9 billion compared to 98 billion for the first 3 months of their last fiscal year. And in their financing activities, we can see they've repurchased $56 billion of common stock so far year to date for their fiscal year. And they've also paid out dividends of $11.2 billion, up from $11.1 billion. So they're increasing their dividend payout year over year, but they've repurchased less common stock this year than they did last year. That being said, their stock price is up over the last year, and it's still up over 230% over the last 5 years. So needless to say, it doesn't really look like they need to repurchase more common stock in order to increase their share price, as the increasing profits and the strong cash flow from their business is doing that just fine. So right here, we can see this discounted cash flow model. I'm using a growth rate of 11%. We can see that for 2018, they had free cash flow of around 64 billion and then 111 billion in 2022. So compounded annually over 5 years, that's a historic growth rate of 11.69%. We can see that weighted average cost of capital came out to 3.4%. I got that right here by calculating their cost of equity. Book value of equity and debt was 50 billion and 300 billion. Cost of debt for their interest rate on their debt was 2.4%, effective tax rate 16%. Beta, they're a little bit more volatile than the rest of the market with a 1.29 beta. So risk-free return plus beta multiplied by market return minus risk-free return gave us their cost of equity of 11%. 86% of their financial statement or balance sheet is made up of debt. And so the equity proportion multiplied by cost of debt plus debt proportion multiplied by equity proportion multiplied by cost of equity, and then multiplying the debt proportion by the tax yield gives us the weighted average cost of capital of 3.43% to calculate the discount rate for the discounted cash flow model. They have a net debt position of 46 billion, 15 billion shares outstanding, puts their intrinsic value per share at $191 per share, which means that at the current share price, Apple is actually trading below their intrinsic value per share if they are able to continue to grow at the same growth rates for the next 5 years that they were able to grow at for the last 5 years. And that's pretty impressive considering the fact that this is the largest company in the world. So the fact that they are currently trading below intrinsic value per share could definitely make them a very attractive buying opportunity for investors. Right here, compared to other companies in their industry, Microsoft and Google, we can see that Apple has the lowest gross profit margin, the second highest net profit margin, second highest return on assets, and the highest return on equity by far. But they also have a debt to equity ratio that is way higher than their competitors at 2.6 debt to equity ratio. And they also have a price to earnings ratio of 29 times earnings. And they do pay a dividend, although it's a pretty low dividend yield of 0.6. So we can see that based on this, it looks like Apple is pretty competitive. They're basically middle of the pack compared to Microsoft and Google. If you'd want to give it to a company based solely on profit margins, you'd probably want to give it to Microsoft in this case. Lastly, to compare Apple to the other companies we've looked at, we can see that for share price to intrinsic value, Apple is trading at 91% of their intrinsic value per share. At long last, we have a table filled with companies that are all trading below intrinsic value per share. Occidental Petroleum, ExxonMobil, AMD, ConocoPhillips, Chevron, Google, Alibaba, Albertsons, Etsy, and Apple are the only 10 companies we've looked at over the last 50 or 60 videos that are trading below intrinsic value per share. We can see for growth rate, Apple had a projected growth rate of around 11%, not good enough to get them onto that table. AMD had the highest at 83%. For profitability, Apple had around a 40% gross profit margin and a 25% net profit, puts them in 5th place on the net profit table, but not good enough to get them onto the gross profit table. For dividend yield, they had a 0.6% dividend yield, and then for revenue and earnings growth, they had revenue decline of around 1% and earnings growth of 2%, so none of those metrics are good enough to get them onto any of the 3 tables here. Lastly, for stock performance over the last 5 years, we saw that they're up 233% at the moment, so that puts them in 7th place on this table. Tesla has the number 1 spot with a 1,144% return over the last 5 years. So Apple is obviously very competitive in terms of net profit and stock performance. And right now, based on the discounted cash flow model, they are trading below intrinsic value per share. we can see compared to the other companies in their industry, Microsoft and Google, Apple is competitive. They're around middle of the pack, and they do have pretty good profit margin. So let me know in the comment section down below what you guys think of Apple. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.